Okay. I have just been a little bit of a rush, and my setup has been a bit faster than I normally would have liked. So if there's any trouble hearing me, if you could please let me know. Tonight's topic is why negative gearing is the new cool thing to do. And I'm not sure whether it is actually, if it is actually a cool thing to do, but it's certainly become a lot more topical since budget. They're only a month and a half, almost 2 months ago. So we hope to get through a little bit of material tonight. We won't take any more than half an hour. I promise you that. And the main reason I can promise you that is, unfortunately, Richard won't be joining us tonight. He and his wife are in Brisbane, just seeing some specialist medical appointments, as we all need to do every now and then, and they got held up and just haven't been able to make it back to a computer. But he assures me that everything's okay. There's nothing to worry about. It's just purely just that just got run behind as you wait in lines, and probably more so on the doctors that just haven't gotten to them in time. We've all been in those situations. I'm sure you know what I'm talking about. So I will try and get through in around the 20 to 25 minutes of some of the information that we have here. If you have any questions, please let me know. I know that this topic of negative gearing is probably not necessarily skewed towards retirees. We're very conscious of that. However, you may come across people that are talking about it, particularly family members. And if you wanted to share this webinar with them, to give them a little bit of context as to what they could be doing if they're lamenting the recent budget, if they're not too sure what they could be doing, by all means share this with them. But of course, there's always lots of topical conversation, I think, that goes into finance and a lot of misinformation. So by all means, I hope this arms you with a little bit of information, a little bit of the right information, where you can maybe set someone straight. All right. If anyone has any questions as we go along, please use that chat section on the right-hand side of your screen, and we might kick in. All right. So to start with, what is negative gearing? For those that don't know, basically negative gearing is the process of which you go about to create an investment strategy that produces a loss. So you take out a loan, typically from a bank. It doesn't have to be from a bank, but it typically is. You purchase some growth assets. That might be a property. That's definitely the most common. You make sure that your expenses are larger than the income. So your outgoings are well and truly in excess of your income. And then any of those excess losses can be offset against your other income. So for those where the strategy has worked and does continue to work really well is where, someone might have they'll be earning an income where they're paying a lot of tax. They would like to own a property over a long period of time. So they go and they purchase the property, they borrow as much as they can with it to fund the purchase of it, and then they rent it out for a commercial rent, but typically the rental yields currently are around the 3.5%, so it's quite low historically. And of course, interest rates when you borrow money are around 6%, and then you have a lot of the other costs that go along with it. So using a property as an example, those expenses do come in a lot larger. So you have a situation where you have a loss that's been generated. It could be a small loss of a few $1,000s. It could be a large loss of $50,000 or $100,000 or more, depending on the scale of the investment. There hasn't been a limit on what that loss could be. So there is, the negative gearing as far as the way that it works. I've heard plenty of suggestions over the years that say that negative gearing is something that is terrible, purely because why would you have an investment strategy that makes a loss? And as a standalone proposition, it doesn't make any sense. But when you take into account tax and the broader situation of your household finances, the numbers stack up. And it's not a strategy without risk, of course. And, our topic tonight around, doing negative gearing into shares is one that we've done a lot of over the years. Admittedly, we did a lot before the global financial crisis back in 2008 and 2009. However, there's been a lot of work around keeping things a lot more conservative when it comes to negative gearing into shares. But when you negative gear into shares, it's very, very similar to negative gearing into property. You start with an initial investment, and that you can consider that to be your deposit. So some figures that I've used tonight and some examples in later slides. I've used $1 million portfolio, so nothing to sneeze at. But the beauty of shares is you could do a negative gearing strategy with $10,000, $100,000, or $1 million or more. So you got a lot of flexibility there. But if you were to purchase a $1 million diversified share portfolio, you'd start with an initial investment of, say, 20%. So a 20% deposit. We're all familiar with that sort of term. That'd be a $200,000 deposit or equity of some sort being contributed towards the portfolio. You borrow $800,000, so it's a pretty heavy level of borrowing that gets secured against the deposit and then against the $1 million worth of shares. You have a focus in that portfolio of higher growth and lower income, and you will definitely have a situation where you'll have less income than expenses. Your expenses will be a lot higher, and you'll have a gap there, and those surplus losses can be offset against other income, and it can be quite attractive when you look at it that way. So the things that you need to keep in mind with a strategy like negative gearing into anything is really staying in control of the loan. Anything that you are that you don't have control over, or you don't have the ability to manage your control over it, is something that carries an enormous level of risk. And when you borrow money from anybody, whether it's a friend, a family member, which I hope it's not, but it does happen, or whether it's a bank, there is always a risk that the person or the institution that has lent you the money is going to want that money back, or they're going to change the terms of the loan. So when that happens, or interest rates for that matter, interest rates rise. For those that borrowed money 5 years ago at extraordinarily low rates, and are sitting today with a variable rate that's more like 6 or 7%, I think the conversation of whether it was a worthwhile investment would be very different today than what it was 5 years ago, depending, of course, on what it was. So negative gearing into shares is very similar to negative gearing into property. But the reason why we're talking about this tonight is purely because of the budget that we had back on the 12th of May. That was a budget that I think it's safe to say has been quite challenging for a large portion of the population, regardless of your side of politics. I've heard some very good arguments for and against some of these changes that have come in, but the intent of the changes is to make the houses more affordable, effectively, for first home buyers, and I think it will do that. But what the way that they've gone about it is they've outlawed negative gearing. I think it was done 40 or 50 years ago as well, in the 80s, and that's where existing residential property has you're not able to negatively gear against that. So if you were to go out today and purchase a property that's existing, so it's not a new build, you can't negatively gear against it, or I guess you can at the moment, but it will only last until the 30th of June next year. There's this little transitional window, but apart from that, it's effectively outlawed. If you want to negatively gear into a property, you can only do so into a brand new build, and the rules stay the same there. You can use that, you can take any of those losses, surplus losses, and you can move that across. If you already had an existing arrangement, so you already had a property that had, a contract was signed, or you already owned the property and it was already in a situation where it was negatively geared, or at least the property was contracted for purchase prior to the 12th of May this year, that can still be negatively geared. And my understanding at this stage is that it is permanently grandfathered. I've heard a couple of things, or read a couple of articles that have said there's a 5-year window. I can't actually read that in any legislation at this stage. So my understanding is that it's permanently grandfathered. So the majority of negative gearing into property has been against existing residential properties. It's somewhere in the vicinity of 70 to 80% of all negative gearing was going into existing residential properties. So the demand, I think, from investors for existing households has probably just fallen off a cliff. I'm not 100% sure of that, but you do see the odd thing around auction clearance rates and the like that are right down. But I think as far as getting new supply onto the market, will it change that? I'm not 100% sure. Time will tell. But if you're going to negatively gear into a brand new home, you're going to do the contracting and the building of that home. Then you can do that at any time in the now and into the future. So there's a lot of people that I think will have just changed their idea of what to do with their money out of existing arrangements, existing homes, existing houses, and putting it into new houses. So it'll be interesting to see that. However, you don't need to do it. You can negatively gear into shares, and I think there are some great advantages to doing it. I think it's seen that there's more risk in shares, and that houses are a lot safer. I think it's seen that there's a greater return that comes from houses, and there's not a greater return that comes from shares. And there's a bit of an unknown, I think, when it comes to shares, as opposed to being able to see the bricks and mortar. I think I've heard that many times over the years, and I certainly understand it. That being able to see your investment is something that is very important. So the next couple of slides that I've got, we'll just talk to the getting some money invested into a property. I wanted to compare a property versus shares, and then I wanted to talk a little bit about, what are the risks that are associated with each one, and why we think that negatively gearing into shares is a viable strategy, and you don't need to go and purchase a home if it's something that you're not necessarily that comfortable with, particularly in the scale. So what I've got here, I've used an example client of ours who I call Evan. Evan Example is his name, and I use Evan in our financial modeling software for a range of different ideas to flesh out a bunch of strategies and do all of that hard work for me. And Evan, in this example, I've altered his age. He's 45, and he's earning a great income. He wants to invest in property or shares, and he wanted to explore, what's the best way to do it, and how he can, when he reaches age 60, he actually doesn't have any debt left. He wants to have that flexibility when he reaches age 60. So he's got $200,000 in the bank at the moment. He has a strong income. I've used an income of about $200,000. and I've used it as a single person. Now, some individuals, obviously a lot of individuals don't have an income of $200,000, but it's getting more common that a household does have an income of $200,000 or more. And so this strategy can be applied across a household. If two members of the household are earning a strong salary, that this will work very well as well. So what I've got here is a comparison between the two, where we have shares and where we have property. And I've used 15 years worth of data, and I know there's a lot of data there. And depending on what you're looking at, whether you're looking at on an iPad or if it's an iPhone, you're really going to struggle with these numbers. But maybe on an iPad you'll be okay. But I'll talk through it. In both of these tables, the top table is a table for shares from this financial year all the way through to the 2041 financial year. So for 15 years. And then the second table, the lower one, is on property. And in both of them, they're the same. We're purchasing $1 million home or $1 million diversified share portfolio. We're investing $200,000 to start with. We're borrowing $800,000. And I've removed, for this example, any of the acquisition costs, your stamp duties, legal costs, any of those sort of things. So I've removed all of those just so that it's a nice, clean example between the two. And the first thing that I just bring your attention to is the net value. So to make sure that I've got an example between the two, I wanted to use the returns are going to be the same. So when you look over a long period of time, it really depends. I could pick a period of time where shares will outperform property. I can pick a period of time where property will outperform shares. So I just assigned exactly the same rate of return for both of them. And so you'll notice there in 15 years' time that the net value, both of them are about that $1.8 million mark, give or take. So it's a very, very small difference over a 15-year period. So having $200,000 as an initial investment, these figures are the end of the financial year. So that 273 is the end of the first financial year. And then 1.8 is the end of the last financial year, just to explain that. The tax that we've got here is where some of the interest comes in, where you'll see in the first year, this is a tax refund. So the first few years, because you've got a loss that's happening, it's got to be a tax benefit. They've got a young 45-year-old who is earning $200,000 a year and wants to save on tax. And either situation, he gets a tax refund. So it's a pretty good scenario. The first year in shares, he gets a $9,700 return refund, and for property, he gets a $6,700 return or refund. So there's about a $3,000 advantage there through shares, and predominantly that's because there are less costs associated with shares, which I'll talk about on the next slide. But there's also some franking credits, which are for those that are familiar with franking credits. They're a fantastic version of shares and a way of tax equalization amongst all income levels. So if you have a low income, you'll get a large amount of franking credits back, which is basically just tax paid in advance by the company. If you have a high income, you probably won't get any of those tax credits back. So because Evan here has got a large loss associated with the portfolio, he is able to get a lot of those, a lot of those franking credits back. You can see here that over the first few financial years, the level of tax refunds remains quite strong, and it lasts just one extra financial year for the shares than what it does for the property. And then you'll see the level of actual tax that starts to get paid, and it does get larger for property than what it does for the shares. And again, I think that's purely because there are less costs associated with the strategy involved in shares, and there are also the franking credits that will come back in as well. So there's some good evidence there, I think, from a tax perspective, that negative gearing does work, but it actually is has a stronger advantage when you have it invested into shares. So my slide here, I just wanted to do a little bit of comparisons between property and shares. If someone had been considering, so if Evan had been looking at property and he was feeling like he's been sort of robbed, that I can't negatively gear, I'm not going to buy a house anymore, I don't know what I'm going to do. It's not all bad. You can buy into those shares. You can still get a very, very strong rate of return out of it. You can get better tax advantages out of it. And you actually have a lot less costs associated with it. So what I have on here is a $1 million property and $1 million worth of shares. And the stamp duty to acquire a $1 million property is $38,000. The stamp duty to acquire shares is $0. There's no stamp duty. The agent's costs, now you don't pay agent's costs when you're buying, but you do when you sell. So you do pay acquisition costs with shares, and that's about 0.22%. So to buy $1 million worth of shares, you'll pay about $2,200. So it's not a particularly large amount of money. The legal costs, conveyancing, is $1,500 too much? It could be $1,000, $1,500. You'll pay conveyancing costs. In shares, you don't have any conveyancing to worry about. With your ongoing costs in a diversified share portfolio, you have, in a $1 million property, you have rates, you have insurances, you've got repairs and maintenance, and you may use a rental agent as well. If you're managing it yourself, you obviously won't have that, but you can't escape rates, insurances, repairs, and maintenance, that's for sure. In shares, you don't have any of those ongoing costs, so there's a big difference there. Now, I'm told a lot that shares are riskier than property, and I think it's really important to note that on a property, you do have a range of risk there, and quite a lot of them are outside of your control. Things I'm sure you're aware of, such as malicious damage. There's that changeover period. If a tenant moves out, how soon will you be able to get somebody else in? Termites are one of those things that falls outside of the insurance market. So it's a very big risk depending on where the house is. You've got your market forces, you've got government things that are going on, like with this budget. You have an emotional connection. What I mean by that is, I know a lot of people that give their tenants discounts because they're nice people. They don't put the rent up. The rent might not have been put up for 5 or 10 years. There's a lot of tenants that have low rates of rent at the moment, or lower anyway. Interest rates is obviously a risk, but the biggest one I think with property is it's a concentration risk. If you've got $1 million property, you've got $1 million worth of your money in just one investment. There's no greater example, I think, of putting all your eggs into the one basket. You can get rewarded for that, don't get me wrong. So if your property grows at 20% a year, and certainly over the last 5 years, if you had the foresight to purchase $1 million property 5 years ago, you're probably pretty happy, pretty proud of your decision. But we might claim that that's a bit of an anomaly, and over a period of time, a longer period of time, it's unlikely to continue. But nonetheless, the concentration can be a high risk of putting all your eggs in the one basket, but I acknowledge that it can pay good dividends for you as well. In shares, of course, the risk I think that comes with shares is that you have volatility. One day, $1 million could be worth $1 million, could be worth 1.1, it could be worth 900. During the global financial crisis, $1 million invested, in a very short period of time after, would have been worth about 550,000. That sort of volatility can and probably will happen again, to be fair. But if you've got good quality investments, you haven't bought rubbish, you've got a good diversified share portfolio, good blue chip shares, both Australian and international, you would expect that over time, that portfolio will grow. And so the issue of volatility is something that's a short-term risk. It's not a long-term risk. Market forces and interest rates are still things that come in there. Obviously, when you borrow for something, interest rates is something that's going to be a real thing. Now, the next row is margin calls. Margin calls are something that where the 20% that I mentioned there before, that's where you have there's a margin between what the asset is valued at and what your loan is valued at. And there's a margin there. So we're starting with 20%. That's the margin. Now, if it gets too tight, a lender will ask you to increase that margin by putting more equity in. And they give you lots of time, generally until 3 p.m. the following day. So it can be a pretty stressful time to suffer a margin call. Margin calls do happen on property. It is in the contracts, and I have seen it happen, literally, not to me, thankfully, but to some friends, and it does happen. But it really is quite rare, and it doesn't happen often. With shares, it is something that is much more probable to happen, but if you have the right strategy, you get good advice, and you choose the right loan where you will be able to avoid a margin call, or the margin call doesn't exist in that kind of loan, then it becomes a non-existent problem. The size of the investment. Now, in $1 million home, you've got to buy $1 million. You've got to borrow the whole $800,000 using my example figures here. You either do that or you don't, you're not invested. You either do it or you don't. At least with shares, you can dip your toe in the water and then you can grow it over time. You can start with 50,000. If you're going to aim for $1 million, you could start with 50. You could add another 100, another 100, another 500, and then finally to $1 million. You can do that over a course of months. You could even take a couple of years to do it if you want to be a little more risk averse. So the fact that you can do it in stages just gives you so much flexibility, and that works in reverse as well. The liquidity of the investment. If you need money, you need to sell the whole house, but with a share portfolio, you can just sell pieces of it. So it's a much greater level of security when it comes to being able to access that money and even getting it started. So I think if for those that aren't able to get into property purely because of the changes to the budget there a couple of months ago, there are still alternatives to it. New residential property is one, but I think shares are something that's a much more manageable way to do it. You don't have to start large. I've used equivalent values here, but you don't need to start large. You can grow it over a period of time. You can gain more confidence with the investment as time goes by, and you don't need to feel that you are up against the wall just to get started. You can grow into it, and I think it's a much more gentle strategy to build your wealth if you are looking to accelerate that growth over a long period of time. Now, I hope that explains a little bit around why we think that negative gearing into shares is the new cool thing to do. There are a lot of questions that we had originally from yourselves, our existing clients, but also people querying through Google searches and sending us random emails, people that we didn't know, asking us, what are the alternatives? Is this a big problem? They seem to have dissipated over the last few weeks, and I think that's probably because we have legislation now that says, well, this is the rule, and so people now have something that is quantifiable, and they're looking around and saying, okay, well, how can we actually grow our wealth if these are the new rules? So that's perfectly understandable. I've reached my 30-minute mark just about, and I haven't provided any opportunity for questions, but I don't see any that have come in so far. If there are any questions, please get them in now. Please note that our next webinar is again on the third Wednesday of the month. If you would like to attend, we'll obviously be sending out reminders for it, but the registrations are live now. just jump into the membership portal, and on the webinar page, you can register for that next webinar. It's nice and simple. You just click on it. If you're already logged in, once you click on it to register, you're done, and you'll get all the reminders from there. We are really, really interested in feedback. If you have any feedback for us around these, we have, thanks Simon and Trudy, appreciate it. We have lots of ideas around the material that we would like to present, but we would prefer to present material that you would like to hear and is highly pertinent to you. So if you're happy with what we're doing, we'll just keep doing it. If you've got some suggestions, though, we're all ears, and we would love to hear from you. But thanks, everyone. I hope you have a great night, and appreciate your time, taking the time to listen in for 30 minutes to my monologue. All right, I'll talk with you soon.